While the world obsesses over China's rise, India's growth, and Singapore's success, a quiet economic miracle has been unfolding in Southeast Asia that almost nobody's talking about. Malaysia, a country of just 33 million people sandwiched between Thailand and Singapore, has transformed itself from a colonial backwater into Asia's hidden superpower. In 1957, when Malaysia gained independence from Britain, it was a poor agricultural economy dependent on rubber and tin. Today, it's the 23rd most competitive economy in the world, ranks second in Southeast Asia after Singapore, and is on track to become a high-income developed nation. Its GDP has grown 5.2% in 2025 despite global uncertainties. Its unemployment rate is just 3%, the lowest in decades. And it dominates industries from semiconductors to Islamic finance to palm oil that shaped the global economy. But here's what makes Malaysia's story extraordinary. They did it without the resources of China, the homogeneity of Japan, or the authoritarian control of Singapore. Malaysia succeeded through strategic vision, ethnic diversity turned into advantage, and smart policy decisions that other countries are still trying to understand. In this video, we're telling the untold story of Malaysia's rise, from post-colonial poverty to economic powerhouse. By the end, you'll understand why Malaysia is the Asian success story nobody saw coming, but everyone should be watching. Let's reveal how Malaysia became Asia's hidden superpower. From colonial exploitation to independence, the starting point. To understand Malaysia's miracle, you must know where they started. When Britain granted independence in 1957, Malaysia inherited an economy deliberately designed for extraction, not development. Rubber plantations and tin mines enriched British companies while Malayans remained impoverished. Infrastructure existed only to move resources to ports. Education was limited to maintain colonial control. Independence wasn't just political. It was economic liberation, explains Dr. Aziz Rahman, an economic historian at University Malaya. Malaysia had to build an economy from scratch while managing ethnic tensions between Malays, Chinese, and Indians that colonial powers had deliberately inflamed through divide and rule policies. The challenge was immense. GDP per capita in 1957 was just $233. Most Malaysians worked in agriculture. Literacy was under 60%. The country had almost no industrial capacity. Neighboring Singapore broke away in 1965, taking much of the financial sector with them. Malaysia seemed destined for the poverty trap that captured most post-colonial nations. But Malaysia's leaders, particularly Prime Minister Tun Abdul Razak, made strategic decisions that set the foundation for everything that followed. The transformation strategy, from commodities to manufacturing. In the 1970s and 1980s, Malaysia executed one of history's most successful economic transformations. The strategy was brilliantly simple: leverage commodity wealth to build industrial capacity, then transition to high-value manufacturing and services. The new economic policy, NEP, launched in 1970, aimed to reduce poverty and eliminate ethnic economic disparities. While controversial, the NEP created a Malay middle class and business community that didn't exist before, expanding the domestic market and entrepreneurial base. Simultaneously, Malaysia aggressively courted foreign investment with tax incentives, infrastructure development, and free trade zones. Japanese manufacturers led the way in the 1980s, establishing electronics and automotive plants. Western tech companies followed. Malaysia didn't just attract foreign investment. They absorbed technology and knowledge, notes Sarah Tan, a development economist. Workers trained in Japanese factories eventually started Malaysian companies. Engineers from multinational firms became local entrepreneurs. Malaysia used foreign direct investment as a transfer mechanism for industrial capacity. The results were extraordinary. Between 1990 and 1996, Malaysia averaged 9.48% annual GDP growth, among the highest in the world. Manufacturing grew from 13% of GDP in 1970 to over 30% by the 1990s. Poverty dropped dramatically. Malaysia was on track to join the Asian tigers, South Korea, Taiwan, Singapore, and Hong Kong, as newly industrialized economies. Then came 1997, and Malaysia's dream nearly died. The 1997 crisis, Malaysia's darkest hour. The Asian financial crisis hit Malaysia like a tsunami. The Thai baht collapsed in July 1997, triggering contagion across Southeast Asia. Malaysia's currency, the ringgit, plummeted 50%. Stock markets crashed. Malaysia's GDP shrank 7.4% in 1998 after years of nearly 10% growth. The manufacturing sector contracted 9%. Construction collapsed 23.5%. Foreign investors fled. International traders suspended Malaysian-listed shares, trapping billions in a fragile financial system. The IMF prescribed harsh austerity measures, cut government spending, raise interest rates, let weak companies fail. Malaysia's Prime Minister, Dr. Mahathir Mohamad, faced the defining crisis of his career. What happened next shocked the global economic establishment. Malaysia rejected the IMF entirely. Mahathir imposed capital controls, fixed the exchange rate, and pursued expansionary fiscal policy, the exact opposite of IMF recommendations, explains Dr. Jennifer Wong, who studied Malaysia's crisis response. The Western financial media predicted disaster. Instead, Malaysia recovered faster than countries that followed IMF prescriptions. Capital controls prevented speculators from attacking the ringgit. Fixed exchange rates provided stability for businesses to plan. Government spending prevented collapse of domestic demand. By 1999, Malaysia was growing again. The decision to reject conventional wisdom and chart an independent path demonstrated confidence that would define Malaysia's approach for decades. The semiconductor superpower nobody knows about. Here's something that might shock you. Malaysia handles 13% of global semiconductor testing and assembly. Your iPhone, your laptop, your car's computer system. There's a strong chance critical components were processed in Malaysia. Malaysia is the world's 7th largest exporter of semiconductors. Companies like Intel, AMD, Infineon, and Texas Instruments have major operations in Penang, which is nicknamed Silicon Valley of the East. Malaysia produces over 40% of the world's LED chips and 7% of global semiconductor sales. When people think of semiconductors, they think Taiwan, South Korea, or maybe China, says James Park, a tech industry analyst. Nobody thinks about Malaysia. But Malaysia dominates the back end of semiconductor production, testing, assembly, packaging. That makes the entire global tech industry function. This didn't happen by accident. Malaysia invested in technical education, built industrial parks with reliable power and infrastructure, and positioned itself as the China Plus One alternative when companies wanted to diversify supply chains. When the US-China tech war intensified, Malaysia became the biggest beneficiary as companies like Apple and Intel expanded Malaysian operations. Islamic finance, owning an entire industry. While other countries competed in conventional banking, Malaysia made a strategic bet, become the global center of Islamic finance. Today, Malaysia is the world's largest issuer of sukuk, Islamic bonds, and leads globally in Islamic banking innovation. Islamic finance, which prohibits interest and requires ethical, asset-backed transactions, serves 1.8 billion Muslims globally. Malaysia positioned itself as the infrastructure, expertise, and regulatory center for this $2 trillion plus industry. Countries and corporations worldwide come to Malaysia to raise Islamic capital, explains Amina Hassan, an Islamic finance specialist. We have the legal framework, the talent, and the market depth that nobody else can match. Saudi Arabia has the money, but Malaysia has the expertise. Malaysia's Islamic finance sector employs thousands in high-value jobs, attracts investment from Gulf states, and gives Malaysia unique geopolitical influence in the Muslim world. It's an entire financial sector Malaysia essentially owns, a permanent competitive advantage other nations cannot easily replicate. The palm oil empire, controversial but powerful. Malaysia is the world's second-largest palm oil producer after Indonesia, but Malaysia's palm oil industry is more advanced, better regulated, and higher value-added. Palm oil contributes $30 billion annually to Malaysia's economy and employs over 600,000 people. Critics focus on environmental concerns, often valid. But Malaysia has implemented sustainable palm oil certification, invested in yield improvements through research, and moved into downstream processing. Malaysia doesn't just export raw palm oil, they refine it, create derivatives, and manufacture finished products. Palm oil is controversial in the West, but it's economically transformative for Malaysia, notes Dr. Tan Wei Ming. The key is Malaysia's commitment to sustainability standards that balance economic benefits with environmental protection. This balance, leveraging natural resources while implementing environmental safeguards, positions Malaysia favorably as global scrutiny on sustainability increases. The secret weapon, diversity as competitive advantage. Malaysia's greatest asset might be what initially seemed like its biggest liability: extreme ethnic diversity. Malaysia is 60% Malay, 23% Chinese, 7% Indian, plus indigenous groups. This diversity created tensions, but also created unique advantages. Chinese Malaysians dominate business and maintain connections to China and Chinese diaspora networks globally. Indian Malaysians excel in professional services and connect Malaysia to India's massive economy. Malays control the government, ensuring political stability. Indigenous communities in Sabah and Sarawak protect environmental resources that are becoming increasingly valuable. Each community contributes different strengths, explains Priya Krishnan, a Malaysian sociologist. Together, Malaysia offers cultural bridges to China, India, the Middle East, and the West that homogeneous countries cannot provide. This makes Malaysia attractive to everyone. Multinational corporations find Malaysian diversity useful. Chinese companies feel comfortable because of the Chinese community. Indian firms find familiar faces. Western companies appreciate English-speaking professionals. Middle Eastern investors value the Muslim-majority population. Malaysia is everybody's friend, a massive strategic advantage. The 2025 reality: Asia's hidden superpower. Fast forward to 2025, and Malaysia's success is undeniable. GDP growth hit 5.2% in Q3 2025, up from 4.4% in Q2, driven by robust domestic demand, services, manufacturing, and construction. Malaysia ranks 23rd globally in competitiveness and 33rd in innovation, higher than Slovenia, Hungary, Poland, and Qatar. Unemployment is 3%, among the lowest globally. GNI per capita grew 7.3% annually between 1961 and 2023, lifting Malaysia from low-income to upper-middle-income status. The workforce with tertiary education grew from 23% in 2010 to 35.5% in 2023. Malaysia dominates niche industries globally: Islamic finance, semiconductor assembly, palm oil, halal products. It's a major destination for medical tourism. The capital, Kuala Lumpur, is becoming a regional financial hub. Malaysia's Tun Razak exchange aims to compete with Singapore and Hong Kong. Malaysia doesn't make headlines like China or India, but look at the fundamentals, says Robert Thompson, a geopolitical analyst. Political stability, diversified economy, strategic location controlling the Strait of Malacca, strong institutions, educated workforce. Malaysia is quietly winning while others get the attention. Why Malaysia succeeds where others fail. Malaysia's success offers lessons other developing nations desperately need. Strategic vision over ideology. Malaysia pragmatically adapts policies to work, rejecting the IMF when necessary, embracing capitalism while protecting social welfare. Leveraging diversity. Instead of forcing homogeneity, Malaysia turned ethnic variety into economic strength. Investing in education. Malaysia spends 20% of its budget on education aligned with economic needs, producing workers the industry actually wants. Attracting FDI intelligently. Foreign investment wasn't just welcomed, it was used to transfer technology and build domestic capacity. Fiscal discipline. Despite pressures, Malaysia maintains manageable debt levels and reforms subsidies to ensure long-term sustainability. Geographic advantage maximized. Controlling the Strait of Malacca gave Malaysia leverage, but they built world-class ports and logistics to capitalize on it. The future: can Malaysia reach developed status? Malaysia aims to achieve high-income developed nation status, joining the exclusive club of countries that escaped the middle-income trap. The path isn't guaranteed. Corruption remains an issue. Income inequality persists. Dependence on commodities creates vulnerability. Regional competition intensifies. But Malaysia has momentum. The Madani government is implementing structural reforms focused on fiscal sustainability, competitiveness, digitalization, and high-quality investment. The Johor-Singapore Special Economic Zone signed in 2025 will boost trade and investment. Malaysia's position in global supply chain strengthens as companies diversify beyond China. Malaysia has defied expectations repeatedly, Dr. Rahman concludes. They survived colonial exploitation, recovered from the 1997 crisis, and built a diversified modern economy. Betting against Malaysia has been a losing strategy for 60 years. We want to hear from you. Did you know about Malaysia's economic success before this video? What surprised you most about their rise? Share your thoughts in the comments. If this revealed a side of Asia's story you've never heard, smash that like button and subscribe.